Welcome back to The Explainer. Today, we're doing a deep forensic dive into the Claycraft India Limited red herring prospectus. We're taking hundreds of pages of dense financial data and putting it right through our forensic funnel. We're going to distill the whole shebang into clear, actionable takeaways. Let's get right into it.
But before we really dig in, we gotta lay down the ground rules. This explainer is purely for educational purposes and does not constitute financial advice. Please consult a CB-registered advisor before investing, okay? We're just here to look at the data objectively, understand the structural realities of the business, and figure out how to read between the lines of an IPO prospectus.
So, here is our roadmap for today. First, we'll look at the business and manufacturing model. Second, where exactly is the money going? Third, a deep dive into their financial health. Fourth, we'll uncover red flags and key risks. And finally, we'll wrap up with valuation and closing thoughts.
All right, part one, the business and manufacturing model.
So what does Claycraft actually do? Well, they're a massive manufacturer of premium ceramic tableware. We're talking your dinner sets, tea and coffee sets, mugs, platters, you name it. And the sheer scale here is honestly incredible. They manufacture over 5,770 distinct stock-keeping units. I mean, that is literally a staggering amount of dinner plates. They're not some small niche player. They're a high-volume manufacturer selling to retail, institutions, and the hospitality sector.
Now, to pump out that kind of volume, you need some serious real-world infrastructure, right? And this is the physical reality behind all those spreadsheet numbers. They operate two major, fully integrated manufacturing plants over in Rajasthan. And when I say integrated, I mean they do the design, the molding, the printing, and the packaging entirely in-house. But look, having big factories is only half the puzzle. We really need to know how efficiently they're actually running them.
Which brings us to their manufacturing capacity utilization. Check this out. For fiscal years 2024 and 2025, they were humming along at a steady 68% of their 6,000 metric ton capacity. But then, notice that sudden jump up to 82% in the 2026 fiscal year? This is an absolutely crucial data point. They are rapidly hitting their maximum capacity. When a factory hits 82% utilization, they're essentially running out of room to grow unless they build new facilities. So keep that bottleneck in the back of your mind.
Okay, so once those ceramics finally leave the factory, how do they actually get to the consumers? Well, an overwhelming 55.10% of their sales rely on a traditional distributor network. Sure, they have a footprint in modern retail and online, but the lion's share of their inventory is moved by middlemen. This heavy reliance on outside distributors is a massive structural reality of their business model, and spoiler alert, we're going to revisit that in a minute.
Moving on to part two, where is the money going?
The mechanics of this IPO are incredibly telling. This is a 100% fresh issue of up to 54,240,000 equity shares. So what does that actually mean for you? It means there's absolutely no offer for sale from the existing promoters. Nobody is using this IPO to cash out and run. Every single rupee raised from the public is flowing directly into the company's bank accounts to fuel growth.
And here's exactly how they plan to spend it. Look at this precise allocation. 9,070 lakhs is earmarked specifically for expanding their Manda factory, while the rest goes into a flexible general corporate purposes bucket. Remember that 82% capacity bottleneck we just talked about? Well, that 9,070 lakhs is the direct answer to it. They're raising capital to build more capacity. It's a very clear, straightforward capital allocation strategy.
All right, part three. Let's do a deep dive into their financial health.
We need to track how all that factory output actually translates to the bottom line. Over the 3-year reporting period, their profit after tax forms this steep, almost perfect staircase. They grew from 1,350 lakhs to 2,075 lakhs to a very impressive 2,701 lakhs. So their profit has neatly doubled over this window. And on the surface, honestly, that's exactly the kind of growth you want to see right before an IPO.
But we're forensic analysts here, right? We don't just blindly look at raw profit, we scrutinize the margins. Look at the EBITDA margin expanding from 19.70% to 23.33%. And even more importantly, the profit after tax margin rocketed from 9.28% all the way up to 15.02%. Now, this sudden, really aggressive margin expansion right before going public, that's a structural factor you absolutely must weigh for yourself. Is this incredible operational efficiency just suddenly kicking in, or is it maybe a temporary optimization of the books right before the IPO? That's the exact question you should be asking.
Section 4. Red flags and key risks.
Let's objectively unpack the top structural risks here. First off, the ceramics industry obviously requires raw materials, things like kaolin, ball clay, and feldspar. The prices for these commodities are highly volatile. If the cost of clay suddenly spikes, well, that can instantly crush those beautiful expanded margins we just looked at. Second, environmental compliance is a massive hurdle. Running industrial kilns requires constant, strict regulatory adherence. And third, that heavy distribution dependence we flagged earlier.
Let's actually hear it straight from the source. Page 23 of the RHP clearly states, and I quote, "We are dependent on our distribution network. Any disruption in our trade channel could have an adverse effect." Remember, over 55% of their products are sold through these middlemen. If those relationships go south or if distributors suddenly demand bigger cuts, Claycraft has a major problem on their hands. And this is exactly why we let the company's own risk documents do the talking.
Finally, Part 5, Valuation and Closing Thoughts.
We want to be completely transparent and focus on the fundamental multiples laid out in the prospectus. For the latest fiscal year, they're reporting a basic earnings per share of $17.84, a return on net worth of 16.27%, and a net asset value per share of $109.64. So as you do your own peer comparisons against other listed manufacturing companies, these are your baseline numbers. You have to decide if a 16% return on net worth justifies the valuation they're ultimately going to ask for at the final price band.
So let's bring it all together. We've seen a company rapidly nearing its maximum capacity, utilizing a 100% fresh issue to build out new factories, and showcasing some pretty aggressive pre-IPO margin expansion. But we've also uncovered a heavy reliance on distributors and the looming threat of raw material price volatility. So my final question to you is this: do these manufacturing realities and structural risks align with your personal risk appetite? I highly encourage you to use the data we distilled today as a launchpad for your own independent due diligence. Keep learning, keep analyzing, and I'll catch you in the next explainer.